Hello and welcome to yet another edition of Banking Central. I am Dinesh Unnikrishnan. Today I have with me a very special guest, Vice Chairman and CEO of India's largest mortgage lender, HDFC, Mr. Keki Mistry. Sir, it's a privilege to have you with us today. Thank you for giving me time.
Thank you for having me here.
Let me start with, let me go back to a few decades ago. It's been 40 years since you have been associated with HDFC.
Almost 42.
Yeah, in 1981 you joined HDFC, but that was not the first job, if I'm not mistaken. You were with HU, you had a brief stint with HUL and Indian Hotels, and you started with Ferguson.
So I did my articles with Ferguson, AF Ferguson, which in those days was a very big accounting firm, and now is part of Deloitte. And then the last 9 months of the article period, under the CA rules in those days, you could do as an industrial training. So the industrial training I did was with Hindustan Lever. Now what you call Unilever. In those days it was Hindustan Lever. And it used to be in this very building. In this very building. And it was on the 6th floor on the other side.
Yeah.
And then I finished my CA. And after finishing my CA, I worked with Taj. Indian Hotels for about 1.5 years, and then joined HDFC.
So when did Keki Mistry decide to join HDFC? Because HDFC at that point, if I'm correct, it was not a very well-known name.
Very, very small.
It was sort of a startup.
Yeah, almost like a startup.
People didn't know about the housing lending that much. So what prompted you to join?
So I'll tell you, when I was with Taj, they wanted me to go as chief accountant for a hotel in Goa.
Okay.
And in those days, my mother was with us, and she was old and she didn't want to move out of Mumbai. So I said that, no, I'm going to stay on in Mumbai. And in Mumbai, the growth opportunities in Taj were limited. Okay. So at that time, there were 3 offers which came. One was from a multinational, one was from Citibank, and one was from HDFC. So I evaluated all the 3. Citibank, I thought, would probably be the most glamorous, because in those days, everyone who wanted to be something or the other in the banking sector would need to join Citibank. But then I thought Citibank would be so large, so huge, that I'd be just one of the many people in the bank. The multinational, I decided not to, and then finally the choice was HDFC. I did my interview at HDFC and I was very impressed with what I saw. There was a huge amount of freedom, a lot of scope to grow, and in those days mortgage penetration in India was almost zero. Hardly anyone ever took a housing loan, because in those days, in the 80s, taking a housing loan was considered as something which was, I won't say immoral, but something you didn't want to take a loan as far as possible. In fact, you would be shy to be seen in a place which provides loans. That was the culture in those days, in the 80s. So I joined HDFC, and then after that, frankly, there's been no looking back.
So, Mr. Mistry, when you joined, what was it like in the initial days when the housing loan business was still in the formative stages? So, can you recall those days?
Very, very different from what it is today. In those days, there was no competition. We were the only housing loan provider in the country. Okay. And we actually created our own competition over the years. So, State Bank of India, Central Bank, Canara Bank, all of them approached us at some point in the mid-80s, late 80s, early 90s, and said, we want to look at setting up a housing finance system in India, a separate housing finance company. Can you partner us? Can you put some equity in the business? Can you train our people? Can you deploy? Can you send a CEO or put someone in charge of the companies? And we did that, because in those days everything was sort of it was such a huge market. We were not penetrated all over the country, and it made sense for us to partner with people. So that was one. And the other thing is, in those days, there was no concept of floating rate loans.
Okay.
Everything was fixed rate loans. So you took a 15-year loan, very simple, fixed rate loan. Interest rates in those days, there were 3 slabs, as I remember. And you took a loan based on what rate applied to your slab. Yeah. And then that rate remained steady for the next 15 years till the loan got paid off.
Okay.
So products were very simple, basic, very, very straightforward. Our shareholding, there were no foreign shareholding in HDFC or in India in those days, in the early 80s. And foreign shareholding in India only started coming about in the early 90s.
So when did the competition really came up? Was it in the 2000s or when?
I would say we started seeing some degree of competition coming up in the late 90s, which was when some of the banks started getting into housing finance. But very honestly, in all these years that whilst competition has been there, it has never really impacted growth, and no one has had to do anything which is irrational to grow. Because the market is so huge, the potential is so enormous that no bank needs to do anything which is irrational. So you don't see people coming out with very risky products or coming out with irrational interest rates just to get market share. You don't see that. It's a very sane market. It's a very properly regulated market. And in my opinion, will continue to remain like this for the next many, many years.
Absolutely.
Because the penetration level, even after all these 40 plus years of business, the penetration of mortgages in India is only 11% of GDP.
That's right.
You compare that with other countries, we are much, much lower. Even China is much higher than us, and if you look at the Western countries, they are much significantly higher than us. UK, for example, is somewhere in the 60s, US is somewhere in the 50s, some of the European countries are in 70 and 80 and 90%. We are only 11%, which means that the growth opportunity for us from 11 to get to even 20 would take us several years. So it's a huge growth opportunity. Also, we have a young population in India. As you know, 2/3 of our population, as per the last population census, is below 35 years of age. And the average age of a first-time home buyer in India is about 37, 38, 39, in that band. So 2/3 of India's population today is not even thought of, not even contemplated buying a house. But progressively over the next 1 year, 2 years, 3 years, 5 years, 10 years, all these younger people will get to an age where they will necessarily have to buy a house. So in my opinion, there will be a structural increase in the demand for housing and therefore housing loans in India.
So there's a big opportunity lying out there in the market for all the
huge, enormous
players.
opportunity. Absolutely, enormous opportunity.
So 4 decades have passed since those early days. Now it's 2023. See, if I ask you to recall, what was the biggest challenging phase in your career at HDFC? What was the biggest risk in the market, the crisis that you have encountered?
I don't think there was any real crisis, fortunately, touch wood, that we ever sort of encountered. But obviously, there were certain challenges along the way. One challenge I would say would be at some point of time could have been funding. You take the example of 2007, 2008, the global financial crisis. When you had the global financial crisis, there was a huge shake-up all over the world and including in India. And raising funds in those days to sustain growth was a challenge. That was one challenge. Another period of challenge could have been 2013, when there was the Fed comment about rate hikes and the so-called taper tantrum, as they call it.
Right.
And again, interest rates shot up. ILFS happened in 2018-19. So that was not a challenge for us because we actually saw flight of money coming to us.
For the smaller NBFCs mostly.
For some of these smaller players, there was a flight. So in these types of uncertainties, in today's times, we are actually a beneficiary. Because then there is flight to safety. So people shift their investments or their deposits from what they perceive are risky instruments to someone like a HDFC deposits, which is considered very stable. So if you ask me, the very initial years when we started, there were challenges. Because to get the first funding, to convince people, to convince institutions in India that a housing finance system could work was a big challenge. And I think the two big, big benefits or the big changes that happened was we first got a loan from LIC, which gave confidence to the local market to lend money to us. And then we got a small $4 million loan from IFC, International Finance Corporation. In hindsight, that turned out to be the most expensive borrowing we ever did. Because in those days, in the early 80s, there was no system of hedging foreign exchange risk. All you could do is you could take 6-month covers. And every 6 months you would go to take a cover, the rate was higher and higher and higher. We drew the money at an exchange rate of 7 rupees and 96 paisa. And when we repaid the loan, the exchange rate was nearly 17.5 rupees. So
Cost was.
So therefore, the cost was very high.
Yeah.
But it's a loan which we will never regret because it gave confidence to the Indian market to provide funding to us. And after that, frankly, touch wood, there's never really been any looking back.
Absolutely. So if you look at, sir, from those days, now we are almost on the verge of a historic merger between the two
Correct.
group companies, HDFC,
And the bank.
the most biggest, if you ask me, the biggest iconic brand in the mortgage market ever in modern India has ever seen,
Sure.
is going to merge with the bank. So when you look back, what is the feeling as somebody who has built this over 4 decades, now it's going to, for a fresh start,
Sure.
what's the feeling?
See, over the years, over the last 20 years or so, let's say, last 20, 25 years, we have periodically looked at whether there should be a merger between HDFC and HDFC Bank, time and again.
Yeah.
Because it's always better to have everything under one roof because it makes business so much simpler. Today, for example, the bank does not do housing loans. We do only housing loans. The bank sources loans for us. They bring application forms to our office. We do all the credit processing, the legal checks, technical checks. We disburse the loan. Then the bank has to has a right to buy back a certain percentage of these loans. So the whole process is not as seamless as one would like to see it. In a merged entity, the process becomes completely seamless. So that advantage of a merger was always there. But when we used to evaluate it in the past 5 years, not 5, I would say probably last we did about 8 or 9 years ago, or prior to that, the regulatory cost of a merger was very high.
Okay.
But gradually over the last 7, 8 years, regulatory costs has been reducing. For example, CRR SLR requirement has come down from 30 odd % to 22 odd % now. Priority sector loans, there are now ways in which you can buy priority sector lending certificates if you feel short of meeting a target. If we raise long-term funding, then the long-term funding and use it for doing affordable housing loans, then to that extent we don't have any reserve requirement or any priority sector lending requirement. So all these things have over the years reduced the regulatory cost of a merger. And therefore when we evaluated this, of course COVID took away 2 years from doing anything. But post-COVID, when we evaluated it, we found that the regulatory cost of a merger had significantly reduced. Right. And the benefits of a merger had, if anything, become even stronger. And therefore, it made it just made logical sense to look at a merger at that point of time.
Sir, do you think there will be, because as HDFC as a housing finance company had a specific culture that linked it to the common households, that made it a household name. That I recall my conversation with Mr. Deepak Parikh recently about this. So this is something that you had so many competitors in the market, but most of them lost out and HDFC won over decades. But a bank may have a separate game, the way they deal with their customers, the way, the operational style, etc. Do you think there will be a clash of this culture when the...
I don't think so. See, the difference between a merger of two banks and the merger of HDFC and HDFC Bank, it's very different. Because in two banks, when two banks merge, you'll have common products. So both banks have housing loans, both banks have car loans, both banks have credit cards, demat accounts, savings accounts, so on and so forth. So there is commonality of people, there's commonality of function. Here that is not the case. The bank does not do housing loan and HDFC does not do any other product other than housing. Mm-hmm. And therefore every single employee from HDFC gets absorbed into the bank. Okay. Whatever we've seen of culture, we don't see too much of cultural differences between the two entities. And all our staff, we have reassured that every single employee of HDFC will be taken in the bank. Every single employee of HDFC's compensation will be more than adequately protected, including whatever stock option benefit they were getting in the past. We've not seen any, our attrition rates, people leaving, has still remained under 5%. We have probably the lowest staff attrition rate that you will see in the financial sector, not in India, probably in Asia, and probably one of the lowest in the world.
So all the employees of HDFC will be absorbed in the merged entity?
Correct.
Even if
unless there is an age limit.
Overlap.
If leaving aside age limit, everybody will be absorbed.
All right. Which role will we see you taking up?
No, I would not take an active role in the bank. I've said that at the time of the merger itself. Yeah. In terms of age limit, the RBI puts certain age limits, and I would be soon reaching that age limit. Yeah. And for the last 5 years, my family's been pestering me saying that you need to spend more time on family, doing things for the family. And so I have other plans, but
you won't be taking up any executive role, but
I will not take an executive.
You will be joining the board, right?
I could look at joining the board. That's an option. I'm today also on several boards. I'm on the board of TCS.
Right.
I'm on the board of Flipkart. I'm on the board of Torrent Power. There have been 2-3 more people who have approached me in recent times and saying join the board. So I'm evaluating all of that.
Correct. Sir, recently HDFC raised 25,000 crores from the market,
Correct.
which is
The largest bond issue.
this is the largest ever you've done. Is it something that was part of the preparation in the run-up to the merger? Was it?
So it's a combination of two things.
Yeah.
One is the sustained demand for housing in India has remained strong over time. So one is to continue funding the growth that we would see. Second is in anticipation of the merger, we want to build up a lot of liquidity.
Okay.
So if you look at the liquidity coverage ratio, we are required at this point from a regulatory standpoint to carry about 60% LCR, what they call liquidity cover ratio. We are actually over 100%.
Okay.
So we are carrying all the liquidity that would be required, that when the transition happens into the bank does not have to worry about liquidity, at least in as far as the housing finance business would be concerned for a certain period of time. And also 25,000 looks very large, but you must also bear in mind that historically we always keep going to the market and raising money in shorter amounts. So 5,000 crore, 10,000 crore issues is something we keep doing periodically.
Okay.
It's just that this time it sort of got all grouped together and we've done 25,000 crores issue.
As you just mentioned, sir, for HDFC Bank, the mortgage is very little at this point, I believe. They
don't do housing loans at all.
Yeah.
They only buy housing loans from HDFC, and they could be buying housing loans from a couple of other entities. But it's a very small part of the portfolio.
So post-merger, when this huge housing loan portfolio goes to the bank, who is going to head this mortgage division?
So individual people who will head what, which will do for which function, all that is still being worked out at different levels within the bank. We have integration committees. There are several integration committees. For every single activity, there is an integration committee. And there is an overall integration committee comprising, I think, 6 people between HDFC Bank, which oversees what the other people are doing. So all these things are getting worked out.
So in terms of regulatory approvals, I believe most of the approvals have come. The NCLT has...
NCLT, we need the final approval in hand, which hopefully should happen sometime in the course of this month.
So as was informed earlier, the merger should take effect from June onwards.
So June, July is probably the date when the merger will happen. See, one thing you must understand is that HDFC is not a single company. We are a financial conglomerate.
Yeah.
So we have 5 regulators. We have RBI, NHB, SEBI, IRDA, pension regulator, and many of them have their own procedural requirement which needs to be complied with. So by our sense, by around June, July is the time when we think all these regulatory approvals should be in place. Now, I would not be able to give you an exact date but somewhere in that vicinity, which has always been our guidance right from the beginning.
Also, I was just looking at the regulatory part. There are certain areas probably a bank cannot enter into lending operations, but an NBFC can. So is there any such portfolios that the HDFC will have to pare down?
So if you look at the individual business, there is virtually nothing that we do which a bank cannot do.
Okay.
On the non-individual book, there are certain kinds of loans that theoretically we could have given which a bank cannot do.
Okay.
So what we've done is, one is we've asked for grandfathering of those loans. But whenever these loans have matured in the last 1 year or so, we've not sort of renewed the loan. We've just got the loan paid back.
Okay.
So to that extent, if you see the individual loan book, it has continued to grow and grow very rapidly. We've seen a strong growth now for several quarters. But the non-individual book, if you see, has actually been declining a little bit from time to time because we are paring away, not renewing loans which would not qualify in the banking system.
So one final question about the merger and then we'll go to the larger, broader market issues. What is your advice to the post-merged entity in terms of the focus of the new mortgage loans?
So, in my opinion, the growth of housing loans in the bank can be extremely strong.
Okay.
By virtue of the cross-sell opportunities that get thrown up.
Yeah.
If you look at HDFC Bank today, just about 2%, roughly, I'm giving you rough numbers, 2% of the customers have loans from HDFC, only 2%. 5% have loans from other banks.
Okay.
Total penetration, or totally about 7% of the customers of the bank have loans. So the ability to cross-sell to the 93% who do not have a loan at all, and maybe even to the 5% who have loans from others, is enormous. Today the bank does not distribute housing loans from all their 7,000 branches.
Right.
But gradually, with the passage of time, with every incremental, every month that sets in, the objective is to train more and more people so that we can start distributing housing loans or start selling housing loans from more and more locations of the bank, more and more branches of the bank. So I would be very, my expectation would be that the growth opportunity for housing in a banking structure can be much higher, even higher than what it has been at the HDFC level.
What about the rebranding part? In many areas, particularly in Tier 2, Tier 3 cities, when you say HDFC, for many people it is the housing company more than the bank.
Correct.
Sometimes, so the rebranding is also very important. How do you communicate this to the consumer?
It's not so difficult because the name is the same.
Yeah.
So whether it is HDFC Bank or HDFC Limited, people recognize the name HDFC, which remains the same.
Yeah. So coming to the current interest rate scenario, Mr. Mistry, this is a time when the RBI has, consecutive hikes of 250 basis points.
Correct.
So what is the trend you have picked up on the ground from your customers as far as the demand for home loans are concerned in this high interest rate scenario?
See, first of all, you must understand that a housing loan is very different from, let's say, a consumer durable loan.
Yeah.
When you take a consumer durable loan, the term of your loan is 18 months, let's say.
Yes.
Now, if you take a loan today and the interest rates are high, it is unlikely, in my opinion, that in the next 18 months rates will come down. So if you take a loan today, you may have to continue with that high interest rate environment for a significant portion of those 18 months. But when you take a housing loan, your housing loan is a 15-year loan.
Yes.
Nobody in India gives fixed rate loans. We cannot have fixed rate loans because we can't match assets and liabilities. So everyone gives floating rate loans. When you take a floating rate loan, honestly, if you look at it economically, it doesn't make too much difference whether rates are high at the time you take a loan or low at the time you take a loan. Because if they are high today, at some point they will come down.
Right.
And if they are low today, at some point they will go back up high. So you will, in a 15-year term of a housing loan, see, at least in my opinion, 3 to 4 cycles when rates will go up and rates will come down. So the point of time when you take a loan sentimentally has an impact, but economically has a much, much lesser impact than on a shorter term loan product.
So which means that one shouldn't expect any large deviation in terms of loan growths in housing loan market.
So growth, yes, growth continues to remain fairly robust.
Yeah.
But you must also understand that when you are looking at growth in the first quarter and second quarter, you are comparing, I'm talking of the system as a whole, I'm not talking of HDFC in particular. You are comparing it with the previous year, where the first quarter of last year, April, May, and a large part of June of 2021 was impacted by the second wave of COVID.
Okay. So the base effect.
And therefore the base effect would have shown a much higher growth in the first and second quarter, which over a period of the 4 quarters will start getting sort of rationalized. So you will continue seeing growth in the housing business. You will continue seeing strong growth in the housing business, but percentage-wise, because the previous year's first quarter was relatively low, the percentage will be lower.
Yes. What about the asset quality part? There are fears about, persistent talks about recession, global recession happening, which could translate into the local market in terms of job cuts and income losses.
In my opinion, first of all, I'll come to asset quality.
Yes.
But when you look at globally, our dependence on global economy is much lesser than most other countries, because ours is primarily a domestic economy. Yes. We are dependent more on what happens overseas because of oil. So if there is theoretically recession in the West, which I don't see happening, let me first say I don't see that happening.
You don't see that recession
happening? I don't see the recession happening in the West. But theoretically, purely theoretically, if there was a recession, it would lead to a slowdown in demand in the West. If it leads to a slowdown in demand, you would start seeing oil prices come down, which is good for India.
Right.
All right.
Yeah.
So that's the first point.
Okay.
Now your second point on asset quality, See, as I said, if I take the last 20 years, I would have seen at least 3 to 4 cycles when rates would have shot up dramatically. 2018, 2013,
Right.
and I would say 1 or 2 more times in history. You see very sharp increases in interest. ILFS happened in 2018, rates shot up.
That's right.
2007, 2008, global financial crisis, there was so rates go up, rates go down. And over a period of time, as I said, it all settles down. So we've not seen any increase in non-performing loans happening at any point of time in the past arising out of sharp increases in interest rates. So hopefully that should not happen.
Sure. Another thing, sir, I would like to hear from you is there has been a long debate on the Reserve Bank of India's approach towards the NBFCs, including the mortgage lenders compared with the traditional banks. So one of the things that was cited as some of the people, including Mr. Parekh, for the merger was that this vanishing regulatory arbitrage for the NBFCs. That at one point in time, businesses used to be shown interest to take the NBFC route, which is kind of vanishing now.
See, at the end of the day, in any financial sector, in any financial system, there has to be some degree of evenality or some degree of commonality in the regulations. Some regulations can never be common. For example, banks have access to CASA deposits, current accounts and savings accounts deposits. Because they have access to low-cost deposits, there is a cost of CRR SLR that is imposed on banks. NBFCs don't have CASA deposits, therefore they do not have any CRR requirement. But in other aspects, whether it comes to accounting, whether it comes to recognition of non-performing loans, whether it comes to carrying a certain amount of liquidity in the balance sheet, regulations have to become aligned. You can't have different regulations for different entities, unless and until it is required by some, for some reason. So I don't think it's a regulatory arbitrage which led to the merger. Let me correct that.
Okay.
It's not that it was a regulatory arbitrage which led to the merger. The merger made sense today because the regulatory cost of a merger today has come down significantly compared to what it used to be historically. And it always makes more sense to deliver the mortgage product seamlessly, to do it from one entity rather than one entity sourcing the loan, another entity processing the loan, selling part of it back to the first entity, and so on and so forth.
That is a very important point. So the primary trigger for the merger itself is the lowering of the lower regulatory costs compared to the previous years.
Absolutely. That's what, and the merger always makes sense. It's not that we looked at the merger for the first time now.
Yes.
We have looked at the merger time and again in the past, but in those days the regulatory cost was such that it did not make sense from a. Today, the way we see it, the regulatory cost has reduced significantly. The synergies of a merger have, if anything, increased further, and therefore the merger becomes profitable from the very beginning.
Yes.
And also your question on regulatory arbitrage, let me also say that it's not that NBFCs have no role to play. I think NBFCs have a very important role to play in the economy and should continue to play an important role in the economy. It's just that from a regulatory standpoint, you can't look at NPL classification differently from banks and differently from NBFC. These things have to get you have to have a common method of doing these things. I'm not talking of just NPLs.
Yes.
Most other things, but not CRR SLR, which is peculiar to a bank.
There is a view that HDFC, of course, is a unique case. It has its own positioning in Indian market. But for many smaller NBFCs, we have seen this feedback that the cost of funds have been rising too fast, and the competition is becoming so tough compared to the bigger banks and the rivals. So, do you see a phase of consolidation emerging in the NBFC space, particularly in the home loan market?
I don't see any particular sudden phase of consolidation happening in the system. Frankly, I don't see that. Cost of funds will go up and rates go up. It'll go up faster for NBFC than it does for a bank, because banks will always have 30, 40, 50% of the money lying in CASA deposits where the cost doesn't increase much. So when rates go up, NBFC's cost goes up faster. When rates come down, NBFC's cost comes down faster than
Correct.
So that's it's the nature of the business. It doesn't mean that NBFCs will go out of business or that the competition is going to kill NBFCs. NBFCs typically cater to a market that banks don't cater to, many NBFCs.
Yeah.
And they have a very niche customer base which will always remain a strong customer base for that NBFC, and banks would find it difficult either to penetrate to that market or to reach that market, or they'll have their own risk aversion which will prevent them from doing that. So in my opinion, NBFCs will always be present. Rates going up is also reflected in lending rates going up. You should never look at cost of funds in isolation.
Yeah.
Because cost of funds is, if cost of funds comes down, lending rates come down. Correct. If cost of funds go up, lending rates go up.
So another thing I would like to hear from you is that what is your view on this emerging fintech partnership? Because this is becoming a larger trend now, and fintechs wants to participate with the bigger NBFCs and banks. Are they a competition for the traditional players or an enabling?
No, I don't think fintechs are competition for traditional players, excepting maybe in very niche products like payments and things like that. Otherwise, I think they're supplementary to the banking system. And you would see more and more banks using more and more fintechs, or looking at acquiring or merging with some of these fintechs, or taking them under their wing, or using them for some specific activity or the other.
All right. So what is the general outlook on lending rates? So we are expecting, the general consensus is that there will be another 25 basis point hike in RBI rates maybe soon in the next policy itself.
In my personal opinion, and I'm giving you purely a personal opinion, inflation in India has been by and large controlled. We saw inflation go up to 7.7%. I think first of all I must say that we handled this whole COVID situation remarkably well.
Okay.
And full compliments, full kudos to RBI, to government for what they did. We did not keep pumping liquidity in the system like some of the other countries did. We did not go overboard with liquidity. We ensured that every segment of the market which needed liquidity had access to that liquidity. We therefore did not see the failure of any institution. Everyone had adequate liquidity. But we did not go overboard. And because we did not go overboard with liquidity, we did not have the kind of tearaway inflation that the Western countries faced. Our inflation was caused more by the Gulf, by the Russia-Ukraine war, which resulted in higher oil prices, and we are even today a large importer of oil. The average price at which we had imported oil prior to the war was $75, and then for some period of time oil prices went up to $100, $110, $120, which had an impact on inflation. So inflation went to a peak of 7.7, came down to 5.7% 2 months ago. Last month saw a little spike once again, but that was more to do with certain specific food-related items, which hopefully are seasonal in nature.
Cereals and vegetable sector.
So in my opinion, a 25 basis points hike in rate is possible in the coming period. I still do not see much more than 25 basis points. The comments made by the US Fed yesterday are a little worrisome. We need to evaluate that, because the US Fed has once again said that rates will remain high, and the trajectory may be even higher than the market expected. We need to see how that evolves over time. But from an inflation standpoint, I don't think we need to do too much in terms of interest rates. India is a young country. We need growth, we need jobs, and job creation happens when interest rates remain manageable. So 25 basis points is all I see at the moment. But if Fed continues being more and more aggressive in their rate hikes, then again it's a position we'll have to keep evaluating.
So you don't see rates going beyond this last 25 basis points?
Unless you see some action from Fed which is much higher than what was being envisaged.
Yes. That brings us close to the end of this very insightful chat, and thank you so much once again, Mr. Mistry, for giving us time. Thank you.
Thank you.